morning, y'all, and welcome back to my channel. Thank y'all so much for tapping back in to see what I have to say. I promise y'all, it truly does mean the world to me. But with that being said, what are we talking about? We are talking about these ISO gems, okay, you guys? I promise you, I'm just showing you guys in multiple different ways how the institutional adoption of this technology is happening, not just on the physical level of these companies now starting to exchange and build in this technology into their everyday processes. That's one side of it. The other side of it is you have boomers. You have literally Gen X or some older ones that have true institutional capital. Okay, you guys, and truly understand that, of course, millennials and then Gen Z and Alpha, that's going to be nothing but digital. Understand, nothing but digital. But you have this regulatory shift that's happening, and anyone that has true institutional capital is starting to pay attention because it's now being talked about on the mainstream news. And this is where they get their particular news from. Your Bloomberg business, your Fox business, your MSNBC and CNBC. These financial analysts that come on and talk, this is how they get educated about the market, you guys. Understand truly what's being happening. And now you have a financial analyst on the mainstream news saying that you need to start allocating 10 to 40% of your portfolio into distributed ledger technologies. Understand what is truly happening, because they see that the dollar's value is getting ready to go down as more and more of this money is printed when things like Trump's big, beautiful bill is passed through Congress. Understand that is trillions, y'all, trillions of dollars. And it's way more than just that 4 trillion in tax cuts. It's another 4 trillion for something else, another 2 trillion for something else. It's a huge bill, okay? Follow me on this. And these assets that are literally creating the rails in which this money can flow on, are going to be extremely valuable because you have transactions flowing through these networks at massive levels. This is why Hedera can do 10,000 transactions a second without sneezing. 100,000 transactions a second is already baked into the system. Think about what's truly being laid out right in front of our faces, you guys. I promise you. But here we go from this interview. They are talking about literally, you guys, allocating 10 to 40% into crypto. And this is how they are now educating their institutional clients. Follow me on this. I'm always going somewhere. I'll be right back.
Was released this week where you called for financial advisors to allocate a minimum of 10% to crypto in more conservative portfolios and up to 40% for more aggressive scenarios. You also call the traditional 60-40 model, quote, obsolete. So take me through that thinking, and why do you feel like up to 40% to crypto is an appropriate allocation?
It's great to be here with you. There are really two parts to this conversation. The first part has to do with longevity, nothing with crypto. Longevity is changing in unprecedented ways in human history. In 1900, life expectancy in the US was 47. Today it's 85. And over the next 30 years, it's going to be expanding to age 100 and beyond. And as a result of this, the traditional 60-40 model is obsolete because that was built 30 years ago on the assumption that you'd retire at 65 and be dead at 85. That's no longer the case. Today, you're going to continue working into your 70s, 80s, even into your 90s, partly because you're going to need to economically, but also because you're going to be healthy enough to engage in the workforce. You're going to want to continue giving back and participating. And so today's 60-year-old is kind of like yesterday's 30-year-old. Meaning if you're a financial advisor and you had a 30-year-old client who was saving for their long-term future, you would tell them to put 100% of their money in stocks because they have 50 years to go. Well, so does today's 60-year-old. So there's no reason to have only 60% of your money in stocks at age 60 and drop that in your 70s and 80s to only 20 or 30% of your assets. You need to have a better return than you can get from bonds. That means stocks. And you need to hold it in equities longer than ever before. So instead of 60-40, today it should be 70-30, 80-20, 90-10. for much longer than traditionally we've been doing. And within that huge equity allocation, crypto needs a much bigger role because it's representing the best investment opportunity of the decade.
Now I want to point out that your current viewpoint represents a dramatic shift from before when you used to tell investors and recommend that investors allocate low single digits to crypto in portfolios. So what has changed now? Why do you think specifically now you can allocate up to 40% in portfolios? I mean, that's a big jump.
It sure is. In my book, The Truth About Crypto, which was a #1 Amazon bestseller, that was in 2021, just 4 years ago, and I said 1%. Today I'm saying 40%. That's astonishing, right?
Yeah.
Nobody ever anywhere has said such a thing as what I'm saying now. Why the shift? It's because of the massive change in the evolution of crypto that we've enjoyed in the past 4 years. 4 years ago, we didn't know if governments were going to ban Bitcoin. We didn't know if the technology would become obsolete. We didn't know if consumers might not want to adopt it. We didn't know if there'd be any institutional engagement. Today, all those questions are resolved. In the Trump administration, in the new Congress, there is massive support for crypto. Every member of the president's cabinet personally owns Bitcoin. Every major economic appointee of the president, the secretaries of Treasury, Commerce, Department of Labor, the heads of the SEC, CFTC, OCC, FDIC, all of them huge supporters of crypto. There's no longer a question as to whether the government likes this or not and is going to support the development. We also now see institutional investors engaging in ways never seen before. Banks are now permitted for the very first time, along with brokerage firms, to trade and custody crypto, which they could never do before. Stable coins are now Goldman calls it the killer app of crypto. We now have a huge array going in, and in fact, the first legislation out of Congress is crypto legislation, the Genius Act. So it has radically changed. It is now a mainstream asset. And we look at the adoption rate, it's still incredibly low. It's only about 5% of the global population that own crypto at this stage. As more and more get involved, learn about it, discover it, and invest in it, we're going to see massive asset inflows. And because, and certainly in the case of Bitcoin, it's a fixed supply asset, the more people who buy it, the higher the price is going to rise.
You see how they are now talking about distributed ledger technologies. And they are it's such a positive and future facing light that they're now painting Web3 in, because they are getting ready to flood this markets with so much capital you can't see straight, because you now have countries, you now have central banks, you now have governments, you now have multinational corporations, you now have small businesses all utilizing things like stable coins to send payments. And understand, stable coins are built on distributed ledger networks. Understand what's being laid out right in front of our faces, you guys. I promise you. And you have these networks, something like a XRP or a hedera, that have tons of billion and trillion dollar companies, things like an NVIDIA, already tied to it, you guys. Follow me on this. I'm always going somewhere. But here we go, more from that interview, because it was very enlightening to see what is now being disseminated to our grandparents, basically, and our parents, in regards to this space. Because you have to remember, for so long it was said it's bad, it's bad, it's bad, don't do it. But now we're getting regulation, and with regulatory clarity will come the deployment of these ETFs, because there's lots of them coming in, getting ready to hit the market, and majority of them are these regulatory compliant gems that we talk about. Your XRP, your XLM, your hedera, you already have like Ethereum, you already have your Bitcoins. Understand what's getting ready to happen, you guys. You're going to have these institutional players deploying levels of capital that's going to make your head spin. Here we go, this next video, and I'll be right back.
Going back to your new allocation thesis, you mentioned longevity as a factor, but I read that you also point to the continued growth of blockchain technology. Can you expand on that and talk to me about some of the factors, the other factors that you think warrant that up to 40% allocation to crypto in portfolios?
Sure. It all comes down to the fact that the reason we're living longer than ever is due to innovations in medicine, healthcare, neuroscience. This is due to the explosion of computer technology, nanotech, biotech, bioinformatics, 3D printing, big data, AI, and robotics, of course. This is why we have, over the past 150 years, been continually eliminating the leading causes of death. In the 1800s, it was syphilis and pyemia. I don't think anybody ever knows what those are, but they were killing more people than anything else in America in the 1850s. In the 1950s, it was cholera, tuberculosis, typhoid. When's the last time you heard anybody dying of cholera in the United States? Medical science eradicated those. Today, we look at heart disease, respiratory illness, cancer, obesity, diabetes. Medical science is going to eradicate those as well. And that means we need to be investing in these technologies. And I'm not talking about the Magnificent Seven. I don't just mean those big 7 top tech stocks. I mean the broad array of companies that are developing or deploying exponential technologies. This is where the future is going to be, and blockchain technology is one of those key elements in Expo Tech that is revolutionizing commerce on a global scale and is going to totally change finance on this planet.
Speaking at the Vision conference earlier this month, you showed projections revealing that blockchain technology will grow from $176 billion today to $3 trillion by 2030, with tokenization reaching $16 trillion and Bitcoin reaching $19 trillion in market value, which is a nearly 7 times increase from today. So what do you attribute that to?
It's again due to the advent of the technological development that we're seeing and greater investor engagement. These numbers are coming from McKinsey, from the Boston Consulting Group, folks who are really seriously studying these markets, recognizing that we're basically in the 2nd or 3rd inning of this. Go back to the internet in the 1990s. We all wish we had invested in the internet back then, and we missed it. Well, this is Internet 3.0. The first internet was all about connecting people. That's what texting was, and emails, and Facebook, and it was all being able to connect online. Internet 2.0 was the Internet of Things. You know, my phone talking to my coffee pot. Now we're moving into Internet 3.0, which is the Internet of Money. Being able to move money as fast and easy as you can send a text. And this is going to revolutionize global finance.
See? Y'all, this is 2025 is going to be a historic year when it comes to distributed ledger technologies, because this is the year that we get global regulation, and this is the year that the distributed ledger technology sector becomes a real legitimate asset sector in the world. Before, it was fringe, it was degens, it was basement boys, as they want to call it, and money laundering and criminals. Now, moving forward, after this regulatory shift happens and you get these literally countries that move trillions of dollars a day, now building its entire economy on top of. Think about here in America alone, we've had the Treasury Secretary, Scott Bessent, say we're moving to distributed ledger technologies. We've had the SEC Chair, Paul Atkins, say we're moving to a distributed ledger securities market. We've had Caroline DePen, who is the acting CFTC Chair, say they're moving the commodities market to distributed ledger technologies. We've had Nadine Chicard, who is the head of the digital assets of the DTCC, say that they're moving their processes to digital assets. And understand the DTCC alone can literally tokenize $100 trillion worth of assets alone. Truly understand what is being laid out right in front of our faces. And you have these regulatory compliant companies that have been positioning themselves for 2, 3, 4, 5, 6 years, 7 years, depending on how long that particular company has been in existence, like a Quant, like a hedera, like an XRP and XLM and so forth and so on. Y'all understand what's getting ready to happen. This is going to be a historic time. These markets are going to explode in a way that none of us are truly ready for. Like I say all the time, some of these players, especially like a Quant next major move will completely price retail out. because Quant's next major move will be true institutional money flowing through the networks, because they understand exactly what QNT is, and they understand exactly what QNT does, because you have all of these wallets now all of a sudden holding thousands, and in some cases hundreds of thousands of QNT with no ETH, just QNT, which means that someone knows something about something. Follow me on this, because I'm always going somewhere. Okay, you guys, I really appreciate y'all tuning in, and I really appreciate y'all tapping in. If you made it all the way through this entire video, type in 40%, because they are now telling the traditional investor that you need at least 40% of your portfolio inside of distributed ledger technologies, and understand what these ETFs are going to do and what that 40% will mean to your portfolio when it's all said and done. But anyway, I appreciate y'all. To the next time. Y'all already know. Peace out.